So, have you ever heard someone talk about their investment property and say, it's all right, it's negatively geared? Or have you ever thought, negative gearing sounds like a good tax strategy, but I don't exactly know what it means? What we're going to do today is we're going to unpack negative gearing. We're going to have a very quick look at what it actually means and how it can be used, how it can be used very well, and also when it can be used badly. I'm David Thomas from Trilogy Funding, and I've spent the last 20 years helping property investors build property portfolios and organise the finance in the correct structure to suit their needs and help them develop their portfolios as quickly and as largely as they're comfortable. So first thing is, let's have a chat about this word gearing. Right? So gearing just means that you've borrowed someone else's money to help you invest. That is all gearing means. Then, depending on what the rental income of the property is, your property is either going to be negatively geared, positively geared, or neutrally geared. So let's break those down very quickly. Negatively geared just basically means that the interest costs are higher than the income of the property. Neutrally geared means that the interest costs are equal to the income that the property is receiving, and obviously positively geared is the interest costs are less than the rental income that the property is receiving. So the term negative doesn't actually mean bad. In this instance, it's just describing the relationship between outgoings and incoming income. So how does negative gearing actually work? Let's say you go and buy yourself an investment property for say $700,000. Your interest on that property is say $42,000 a year. And then the other property management costs, insurances and things like that, let's say that takes it up to say $50,000 per year. If your income on that property is only coming in at about $36,000 a year, well, all of a sudden you're $14,000 per year behind, and that is your negative gearing. Now, that $14,000 is coming out of your pocket and going into holding the property. But there's a different aspect to it as well. You've got taxation, which sits off on the side. Now, you may have things that are not cash deductions, but are actually tax deductions against that property. You might have, say, for argument's sake, another $5,000 worth of depreciation costs or something like that. So what you'll end up with is you'll have negative gearing from a cash flow perspective, but also negative gearing from a tax perspective. Now, when you do it from a tax perspective, let's say you're negatively geared from a tax perspective by $20,000, then you'll be able to have that $20,000 taken off your annual PAYG income in your tax return, and therefore you will receive a tax return back from the ATO, and you can use some of that money to go and invest in something else, pay off your home loan quicker, or help with your investment property costs. So you can see that there's a bit of a difference there, but it's a structure that enables your tax deductions or your tax return from the ATO to help you hold the property. Now, why would you have a property that loses money? So let's take that instance before. The property was costing us, circa $15,000 a year to hold out of our pocket. We were having $20,000 worth of tax deductions. We're probably getting, say, maybe $6,000 or $7,000 of that back. So our net holding costs were maybe somewhere between $7,000 and $10,000 per year. Not a lot of money, but not an insignificant amount of money to be losing on a regular basis for as long as you have the property. So why would I want to get myself into a situation where I might lose $10,000 a year, $100,000 over a 10-year period on holding a property? Where's the upside? Well, obviously the upside is that $700,000 property, if it's a good, well-chosen property, it might double in value over that 10 years. So yes, you might be $100,000 out of pocket, but you might be able to sell the property for $700,000 more down the track. One from the other, you're $600,000 up, and also it's not income that you're being taxed on, it's capital gain, which has the capital gain CGT exemption or discount. So as you can see, this is a strategy that a little bit out of your pocket over a long period of time, but selling for a big payday later on down the track. So why are so many Australian property investors using negative gearing? So the first reason is leverage and growth. As we discussed before, we're borrowing all of the money that we need for the property from the bank. So we're putting in only the contribution that we make on a yearly basis. And if we do things correctly, the contributions that we put in should be nowhere near the capital growth that we make over the time. Number two is the tax benefits. Obviously, if you're able to claim your loss against your yearly income, the higher your income is, the higher your marginal tax rate is, therefore the more tax savings your investment property is going to be able to give you each and every year. And the last one is long-term wealth creation. Most property investors aren't in it for short-term gains, and they aren't in it for short-term cash flow. What they're in it for is the long-term capital growth that property can provide. It's proven to provide it over the last 70 years, and all indications are supply and demand, it will continue to be a solid asset class in the future. So it's that long-term capital growth that is attractive to property investors. Now, it's not all wine and roses. This can go wrong because with any form of investment, it can be done right, but it also can be done wrong. So let's have a look at the 4 reasons that this can be risky or maybe not have the returns that you're looking for. So the first reason is there is still a shortfall. In what we were discussing before, we still had a property that was going to take $15,000 out of our household income per year to hold. Now, if we have changes in jobs, changes in circumstances, interest rates go up through the roof, and that $15,000 turns to $30,000, there is still a degree of risk that we need to bear. So we just need to be aware of that when we're going into this kind of negative gearing situations. Number 2 is negative gearing relies on capital growth. We are using the forecasted future profit that we're going to make at sale in order to justify what we've done. If the property does not go up in value, if we do not have capital growth, sadly, all you've done is insure yourself for some pretty expensive tax deductions each year for as long as you hold the property. The third reason that we might have issues with negative gearing, it's been in the news over the last couple of years. The government is always looking at changes to tax policy. Negative gearing is a tax policy. So whilst it's great at the moment, there is a chance that that may change in the future. So we always say to clients, don't buy a property because of negative gearing. Buy a good property. It's a benefit if it has negative gearing. And the last issue that we have with negative gearing is it's something that takes cash out of your pocket. So poor cash flow management can be really troublesome for property investors. So you really need to be quite tight on interest costs, on maintenance, on vacancy of your property, anything that is going to give you cash flow issues in the future. We want to make sure we manage really, really well. So when does negative gearing make sense? Negative gearing makes sense when you're on good income, when you're buying good property that could have long-term capital growth, and when you have a significant buffer in place to cover off any kind of cash flow variances year on year. It's an extremely useful tool at the start of your property investment journey. It's the thing that helps you hold property and secure more property in the future. It's not something that you would use for your entire journey, but it is something that's going to help you get your first, second, and third properties going. As we said before, there is a golden rule, and the golden rule is always buy good property. Don't buy a property just because it's negatively geared. Buy a great property, and if the benefit is that it's negatively geared, you're going in the right direction. So how do I use negative gearing strategically to build and create my ideal property portfolio? Step number 1, I use my borrowing power and my negative gearing benefits from a taxation perspective to buy better property, more expensive property in better locations that will perform over the longer term. Number 2, I structure my loans correctly. I borrow as much as I can deductibly, minimizing my non-deductible debt, and I get the most amount of tax deductions I possibly can to help with my property portfolio growth. Number 3, I get as many tax deductions as I possibly can. And this includes getting a quantity surveyor to do a depreciation report on the property that we're purchasing so we can maximize our tax deductions, maximize our taxable negative gearing benefits on the property, and get the biggest possible tax returns. Step number 4, I reassess regularly. Should be looking at properties every 12 months and thinking, is this a property that I want to keep? Has the property gone up in value? Can I access equity against it to go and improve the property or go and buy another property? And just continually following that process year after year after year to make sure you maximize your opportunities when you can. Lastly, rinse and repeat all of the above, and of course, reach out to professionals whenever you can for your advice. And remember, lastly, the goal with property isn't to lose money and it isn't to get tax deductions. It's to buy great property that will increase in value over time and build a long-term property portfolio. So that's what negative gearing actually means. And whether it can help your situation or hurt your situation is exactly that. It's your situation. So if you want to have a chat to someone on an individual basis about your portfolio or starting your portfolio, please reach out to us. I'm sure we'll be able to help and give you some good direction that is specific to your set of circumstances. You can click on the link below, and as always, please like and subscribe to the channel and feedback and comment wherever you'd like.